Hi, in this topic briefing, we're going to take a look at an examiner favourite that's in connection with the choices that businesses need to make as they decide how to grow, and in particular, the choice between organic or internal growth and external growth. Any business that is setting its strategy, its strategic direction, needs to make choices about the methods that it uses to grow. So, for example, here on the left on the chart or the diagram, the possible options, none of which are mutually exclusive. You can do one or more of these. But if, for example, a strategy of international expansion or product development, a strategy based around innovation, what's the best method to use to implement that strategy? Should you go down the organic or internal route? Should you consider a takeover, a merger, or are there other methods of growth, perhaps through a joint venture or a strategic alliance? It's all about making choices about the best methods. The key reason why this is such an examiner favourite is that choice is often difficult, but inevitably all kinds of decisions and choices involve elements of risk. Now, as soon as you think about strategic choice and risk, you should be thinking about trying to implement and use relevant business theories and models in your answer. And the classic model to use whenever you're looking at an essay question or exam question around growth strategy is Ansell's matrix, which essentially tried to frame the decision, frame the options for businesses in terms of their choice about which markets they choose to compete in and which products they choose to offer. When you're looking at organic versus external growth, it's very useful to align your analysis to Ansell's matrix and to consider what the implications of those choices are. And we'll take a look at that. We'll refer back to Ansell's matrix as we have a look at some examples of organic and external growth. Well, we've mentioned those two terms. Let's just quickly refresh what we mean by them. Organic growth or internal growth, you can use either term. It's all about growth that comes from within the business. What do we mean by that? Well, for example, it would certainly include the expansion of product ranges and product portfolios, the launch of new products. It would include exporting, expanding into new geographical markets, selling direct into those markets, or setting up sales agencies and distribution channels in new territories. It would involve the expansion of distribution, perhaps making your product available through a new retail chain or finding a new agent or distributor. And of course, organic growth also includes a concept that's very popular, particularly in service sector industries, franchising. So organic growth, the internal organic strategy is to set up as a franchisor and allow other people to pay you for the right to offer your business service or your business model as a franchisee. So there are lots of different ways in which a business can grow that will be considered to be organic or from within the business. Compare and contrast those with strategic choices that are essentially external to the business, growth from outside the business. And the classic example of that is a takeover. Now, I know we've got a separate topic briefing on takeovers and mergers, which looks at this area in a lot more detail. But essentially, the takeover involves one company buying another, or it could involve a merger where two businesses come together and form a new business, a larger business. But don't forget that external growth options also include concepts such as joint ventures or strategic alliances that essentially involve doing business, dealing with parties, businesses outside of the existing business. As you develop your understanding of business, you soon come across lots of great examples of businesses that have used organic and external growth very successfully. Let's just spend a couple of minutes highlighting these. We're going to highlight some more and showcase some more over the next few minutes. So thinking initially about internal or organic growth, I'm a big fan of the example of Aldi in the UK. Aldi, the German-based discount grocery food retailer that has very successfully expanded and taken market share from the likes of Asda, Sainsbury's, Morrison's and Tesco's and the rest in the UK grocery market. And it's done it through an organic strategy of opening a large number of new stores and very successfully competing on price and to an extent on convenience and range. Classic example of a very profitable organic growth strategy. Similarly, the rapid growth of service businesses and franchise businesses like Domino's is a great example of organic growth, as is Whitbread's Premier Inn concept, which has very quickly become perhaps now the dominant provider of low cost or budget hotel accommodation in the UK. Now, on the other side, that's not to say that takeovers and mergers can't also be a very successful method of growth. So you may have come across the example in particular if you've looked at the IT industry. American-based business Cisco has implemented hundreds of takeovers over the last decade or so and has grown very successfully off the back of those. Tata Group, which we often look at when we're looking at their strategy in relation to their takeover of Jaguar Land Rover in the UK, which is perhaps one of the best examples of a successful takeover. Tata Group, it's an Indian, privately owned Indian conglomerate, paid around about $2 billion to Ford to buy Jaguar Land Rover back in 2008, have invested significantly in Jaguar Land Rover, and as a result of that takeover, they now have a business that's earning over £2 billion a year in profit, a phenomenally successful example. And of course, Google has also been very active in the takeover market, most particularly having bought YouTube several years ago, and has quickly become a very successful takeover for them. Lots of examples in our specific topic briefing on mergers and takeovers of successful as well as unsuccessful external growth. A couple more for you to have a look at. I think I'm a big fan of the coffee market in the UK. Great example to use. Another Whitbread business, of course. We've mentioned Premier Inn. Costa Coffee is now by some distance the leading coffee shop brand and chain in the UK, with almost 2,000 outlets. Almost certainly by the time we get to the end of 2015, it will have over 2,000 outlets, which is double what Starbucks has, which is the next biggest competitor. And of course, it's the classic organic growth strategy, simply opening new outlets. Similarly, we've mentioned Domino's, a great example of a franchise growth. There we can see that since 2006, Dominos UK has almost doubled the number of locations that it operates in the UK, and as a result has significantly increased its revenues, its franchise revenues, as well as its core revenues and its profitability. Now, how do you compare and contrast these two strategies? What are the possible lines of analysis that you could use to assess whether one strategy is better than another? Well, I mean, these aren't the only ways of comparing and contrasting, but I think they're a useful starting point. Thinking about risk, generally speaking, which is why I've put the word usually after 2 or 3 of these points. Generally speaking, an organic or internal strategy is perceived to be low risk than takeovers. Takeovers and mergers have a reputation for frequently destroying value, destroying shareholder value, for all sorts of reasons that we looked at in the specific briefing on takeovers and mergers. But generally, takeovers and mergers are higher risk than an organic strategy. Similarly, organic internal growth tends to be a slower way of growing your business than through takeovers, which have the potential, as I said a bit further down there, to be transformational. Overnight, you can buy a competitor or a similar business and significantly increase the size and scale and scope of your business. Much faster way of adding to revenues and hopefully profits through a takeover. Organic tends to build on what you're good at, what you're already doing. Existing product ranges, existing capabilities, technology, a reputation for innovation, creativity, quality. Those are good things to build a business on, aren't they? Continuing to grow your business. Whereas takeovers, particularly if it involves diversification, have the potential to be completely transformational in terms of what your business does and where it operates. You often see successful organic growth strategies in markets that themselves are growing fast, where there's lots of opportunity for organic growth, or where there's perhaps a weak leader, a weak competitor, where there's an opportunity to grab market share, where an organic growth strategy is just as likely to increase market share as a takeover. Conversely, a lot of the time you see takeovers and mergers take place in markets that have become pretty mature, perhaps not necessarily declining, maybe they're slow growth markets, but that's often the way in which you change the competitive nature of the industry through a major takeover or merger, because there isn't as much growth to be shared around amongst the existing players. And I also like the link with innovation, technology and brands. So I think organic growth strategies very much reward businesses that have good reputations for technological investment, innovation, strong brands that they can leverage through new product launches or product extensions. But don't forget that takeovers can also be a method of acquiring the very things that you might be missing. So if you're under threat from a new technology, it might well be that the takeover enables you to acquire access to that technology which might address that threat. So the classic exam question on this is, which is the best strategy, organic or external? It's a classic exam or essay question. Which is the best way to grow profitably? So what I want to do is just take a look at a couple of possible lines of analysis here to show you how you might build a compare and contrast point, or 2 points in answer to a question like that. So in any essay, of course, you plan 2 or 3 potential points on either side of the argument, and then certainly pick 3 points to develop in your essay. So on the one hand, you can say, well, there's an argument for organic growth as being best for profitable growth because, let's pick the first argument there, the top left, because it enables you to focus on what you're good at. That will be a good argument. And another good argument for organic growth is that it's less risky. It's a better way of giving yourself a better chance of growing profitably. On the other side of the argument, a reason why external growth may be the best for profitable growth is that it has this potential to transform the scale of what you do, and therefore you may be able to achieve economies of scale. And also, if it's the right takeover at the right time and it's implemented correctly, there's a possibility of you becoming almost overnight a significant player in a market. And that might be particularly important if it's a market that you want to enter into that you have very little experience of. In other words, a strategy of diversification. This is a typical line of analysis that you might develop within a paragraph point if you were writing an essay on organic or external growth. So you take your point and develop it. So in this case, our point is the organic growth point, which is that it provides the business with greater focus. It enables it to focus on what it's good at. How and why might that be a reason why organic growth leads to profitable growth? Well, the line of analysis goes something like this. It's not the only way of describing it, of course. Focusing on organic growth enables a business to concentrate its resources on what it does best. It doesn't have the distractions of a takeover or a merger. It just focuses on its existing capabilities. Therefore, investment resources are targeted at maximizing the opportunities within the existing markets with the aim of building market share. So we're immediately using a bit of Ansoff there, aren't we? We're suggesting you can target your resources, your activities at existing markets. And if it's existing products, that's a strategy of market penetration. If it's investing in innovation, it's a strategy of product development. But what it's basically saying is stick to what you're good at and you're likely to see the results of an organic growth strategy. Just developing the line of analysis further by targeting your investment, that should improve further the competitive strength of the business. As the business grows, for example, you may well have now built greater brand awareness, increased customer loyalty. You may have become bigger and therefore starting to achieve economies of scale. You therefore find yourself in a position where you've reduced the risk of existing competitors or new market entrants coming into the industry and taking your fair share of those profits. And in other words, you've captured a greater share of industry profits as a result of focusing on organic growth. And as I've mentioned before, the coffee shop market is a great example of that. As the biggest firms have got bigger, in particular Costa, they've started to take a significant share of industry profits just by focusing on what they're really good at, relentlessly, a relentless organic growth strategy. Let's have a look briefly at another example there, but this time taking a line of analysis that says, no, actually takeovers is a better way of growing profitably. And the argument here is the transformational argument. So a takeover gives you the opportunity to significantly increase the scale, the scope, the size, if you like, of what the business does, and therefore it enables the business to achieve greater economies of scale. How does that lead to profitable growth? Well, the idea here is that by combining two businesses through takeover or perhaps through merger, the combined scale of the business gets bigger. 1 + 1 = 2. But if you can also achieve what are known as cost synergies, reductions in costs, for example, greater buying power, reducing duplicated functions, reducing headcount, you should be able to reduce your unit costs through greater scale, economies of scale and cost synergies. As unit costs fall, that should enable the business to become more competitive, particularly if it's competing in markets where demand is sensitive to price. So you have the choice. You either reduce your price because your unit costs are lower, which should result in high demand, or it means that your existing demand, your existing revenues are more profitable because of this cost advantage that arises from the achievement of economies of scale and synergies, cost synergies, as a result of the takeover. Now, that's a very compelling line of analysis. There's a little bit of Porter's generic strategies in there as well in terms of cost, competing on cost. And then what you do is you'd support it with a couple of examples. The classic example of this is the airline industry, where you see, or certainly historically, there have been lots of takeovers, lots of mergers, particularly mergers amongst airlines. International Airlines Group is a great example of that brought together British Airways and Iberia, and recently they've also agreed a takeover of Aer Lingus in Ireland. And what they're looking to do is to bring organisations and business together, squeeze out the costs so that they can become more competitive in the highly competitive airline industry. Now, of course, the other point to make about organic versus external is it's not a question of either or, is it? We know that in strategy, it's all about choice, and you can do both. So don't forget to make the point that actually, just because you adopt an organic strategy, by and large, it doesn't stop you from doing takeovers. And perhaps the best example of this is Apple. I mean, is there a better example of a business which is now the world's most profitable business, growing through organic strategy? The launch of new products and then product extensions. Of course, the iPhone perhaps being the best example of that is the classic example of organic growth. But that's not stopped Apple from undertaking takeovers, and in particular, most recently, the significant takeover of Beats Music, which was a sort of multi-billion-dollar takeover. And key strategic rationale for doing that, we've seen recently, haven't we, with the launch of Apple Music, and that was the reason why they bought Beats. They didn't buy it for the headphones; they bought it for the Beats music streaming service, which is now going to become the basis for a new product for Apple. So they're back into organic strategy, which is Apple Music. As I said right at the start, this is a classic examiner topic. Which is the best method? Organic or internal versus external? And what I've just done on the screen there is list out 2 or 3 possible essay or exam questions that you might want to have a think about, maybe plan some answers to, maybe develop the line of analysis that I had a go at doing a few minutes ago. For example, let's take the first one there. Do you agree that the most profitable large businesses achieve their success through organic rather than external growth? Now, you might take the example of Apple there and say, well, the world's most profitable business has largely achieved that through a very successful organic strategy based around innovation and quality, but it's not stopped it from also investing in takeovers. Is that compelling evidence that organic strategy is the best? Or could you look at the likes of Tata Group and Cisco and others that have built very successful businesses around takeovers? Perhaps gaining access to new markets and new territories, or perhaps as a way of building that, achieving those economies of scale that enables them to reduce unit costs and to become more competitive. What about the second question there? Is now a good time for multinational businesses to take much greater risks? That doesn't mention the word organic or external, doesn't it? But taking greater risks sounds like that's a question that says, is now a good time for multinationals to invest much more in takeovers rather than organic growth strategies? Taking greater risks implicitly assumes takeovers. Take a look at those questions, have a go, have a plan, and see how you get on. This has been a short briefing on strategic decision making, in particular just thinking about the difference between organic and external growth. Please do connect with us and continue the conversation on Twitter using the @GTD handle or the @GTD business handle. And if you're studying for Buzz 4, don't forget to use the Buzz 4 hashtag as well. This topic briefing has been on growth strategy, and I hope you found it useful.